The new year is here, and with it, a whole lot of unknowns for the market. Rob Spivey with Altimetry Research is breaking down the 3 themes that he's really watching in the new year that could impact the market in a really big way. I'm really excited for the last point you have for us because it's a specific date that could change the whole market. So we'll get to that as your last point. But Rob, let's just start with that first area of the market you're watching in 2026.
Yeah, Bridget, thanks as always for having me on. Great to be able to ring in the new year with, some of these big picture ideas. And, I think that when you look at it, it's that we think that these are the themes that are going to be the most important themes for playing out for the whole entire year. And the first one, as you said, it revolves around energy. And it's the idea that price at the meter is the new price at the pump. There are some really great charts out there and maps that show just literally in the last 5 years, from 2020 to 2025, how much the price of power has changed in different parts of the United States. And it is staggering. Just already, just from 2020 to 25, before really the AI boom really is getting kicked off in terms of all these data centers that we're talking about getting built. I think I saw a number that's like 80 plus gigawatts is currently planned in terms of new data centers being built. And so you look at this, and this is starting to have real big issues in terms of what it means for local politicians. But it is going to mean that there's going to be some pushback in some areas for data centers. But the thing that's way more important is this administration, the Trump administration, realizes that for November, if they want November to play out how they want it to play out, they need to do everything in their power to make sure that power plants get built and that we resolve this issue and the logheads that are running into it and everything else. So we think that if you want to understand the biggest thing that's going to be a play out for the entire year, and it's going to start to become a big issue long before November, because if they wait until November, they've already lost the House and the Senate.
Wow, this is such a huge topic, and those numbers are staggering. The increase of the cost of power that will trickle down to the average American voter out there. I'm also thinking how vindicated dads must feel right now watching this when they get mad about turn off the light, don't leave a room without turning off the light. Well, now it makes more sense than ever for that one. But really, those numbers, Rob, are huge. And I do think that that's interesting how that could impact election results and really having consumers starting to notice that more and more. Let's talk about what that means for the market when it comes to not only the election results potential, but also just stocks that could benefit if that investment does come for energy.
Yeah, right, when you think about this, there's a classic part of the market that everybody kind of understands, right? This is the GE Vernovas of the world and whatnot that are going to benefit. But what we think is really interesting, that's a big beneficiary, is a company that we really like called Bowman. BWMN, Bowman Consulting. And what they do, Bowman is specifically, when you talk about construction and engineering firms, a lot of them out there, they are people who actually build stuff. And since they actually build stuff, they have to take this kind of contract risk where they take on the project to build a power plant, to build out the grid, to be able to build these transformers. Bowman doesn't do any of that. And what's really interesting that Bowman does is Bowman is a consultant. It's an engineering consultancy. You wheel them out when you have to figure out, how do I get permitting for my new power plant? How do I get permitting for my new parts of the grid that I want to put out in terms of, transmission lines or anything else? What do I need to think about in terms of building out for different parts of this, this campus that I'm building out for a power plant or something else? What are the things I have to do? Well, Bowman's the one who you wheel in to do that. And you think this is a company that historically has had when we talk about it, where we look at things in terms of cleaned up data that we look at, return on assets for this business has been, mid-single digits. It has the opportunity for that profitability to significantly ramp up as they get a lot more projects and as they're doing smart things to add new, different core competencies like around plumbing, around how you deal with, transportation stuff. That means whenever you're building out one of these projects, you have to do more and more with them. And so we're seeing their profitability, their return on assets, how we talk about things, could go a lot higher, and the market's not pricing it in yet. And it's going to be a long, long, long trend, because this build out that we're talking about, it's going to last for 5 years, 7 years, 8 years, 10 years.
Yeah, I think that's a good point, that this is definitely going to be a long term, not just all of 2026, but several years in the making. And also really interesting stock. This is a name we have never heard about on this channel before. It's not really making waves in the energy sector. So interesting name, kind of unknown name for investors to look into that could see some potential down the horizon with the moves in energy. I want to talk a little bit more about energy before we move on to that second theme, simply because there's so much talk right now about those small nuclear reactors as well. Is that play a role in this first theme that you're kind of watching, or are you really focused on just those new power plants being built?
Well, and this is the thing. You look for the next, call it 5 5 years at best. Natural gas is going to be the real story here, which is why we're so surprised that natural gas prices have not moved anymore. You're talking about, GE Vernova, Mitsubishi, Siemens, the backlog that they're talking about having in terms of turbines for combined cycle, right, natural gas power plants, that we're going to have a ton more of those. And yet we haven't seen the price of natural gas really move much at all, other than just because it's been really cold this winter. And so natural gas is going to be the front and center of that. We have some companies that we think are really, really interesting that are going to benefit from the nuclear story, but the nuclear story is really a 6 to a 10-year story. I mean, there is not a nuclear power plant that's been built in the United States that's taken less than a decade. Even, when you look at the stuff that's gone on in China, that, some of the South Korean heavy industrial construction engineering firms have built, they still take 5, 6, 7 years. And so we think that realistically, that might be a story in 5, 6 years. Honestly, SMRs, that technology, we ironically in the United States are at the forefront of it because we've been running 90 of them for, 50 years. Because that's actually what happens in subs and also in carriers. But it's a hard thing for you to convert. So we think that normal nuclear is going to be a bigger story.
I think that's a really interesting point because this time last year, Rob, everyone was talking about nuclear energy being the hugest investment. Again, that was really January of 2025, and that was such a huge story. And we didn't really see that come to fruition for some of the big names. It peaked a lot in January, February, and then didn't recover all that much at the end of 2025. Is that just because maybe investors, maybe Wall Street, the market in general, doesn't realize how long-term that nuclear build-out is? I think that stat you just said, that it takes more than a decade to build a nuclear power facility. It's maybe a timeline investors aren't used to.
Yeah, I mean, and if you look, we've only built in the United States one nuclear power plant in the 21st century, right? In terms of, and if you look at it, and that was over budget and over time and everything. 10 years is a good mulligan because that took longer than 10 years. And I do think that, to your point, I mean, you can break out nuclear, those who already have nuclear power plants, and then those who are thinking about building them. And companies like Constellation Energy, right, that already have a lot of nuclear power, what's really interesting that you're seeing Constellation do is Constellation is basically saying, hey, here's what we're going to do. For the nuclear power plants that we already have, that are already producing, for those, as they come off of contract with utilities in PJM and anywhere else, we're going to start to, sell that power directly to a hyperscaler. And then we're going to backfill the power that we have to put in the grid. And that's why they've started to build natural gas power plants. They had a big acquisition earlier this year that basically was about them filling in that pipeline because they're basically saying, hey, nuclear is so stable, which is why everybody wants to run to it. We can get a higher price point for it from the hyperscalers than I can get on the grid. And then I can backfill in the grid with this natural gas power that I can get more readily and build right now. And so I think that you're exactly right. You're seeing that for those kind of companies, it's really interesting because you've got this potential for a step function higher in terms of power prices that they're receiving and therefore earnings. But for the nuclear power companies, I think that a lot of people thought like, oh, for the new ones that are going to be built, well, this is going to be a 2-year story. It's like, no. This is a decade story. And in a decade, we could look a lot more like France does today, where France, I think it's like 70%, 80% of French power comes from nuclear. And it would make sense for us to get there, but it's going to be a bit of a work.
So interesting. And Rob, you are a wealth of information. I love talking to you. I'm excited to hear that third point you have for us, that date that we're talking about. I'm curious how that might impact this point, energy. So we'll get to that discussion in a minute. But first, I want to move on to your second point, the second theme that you are looking for in 2026.
If you look at a chart of the NASDAQ from 1994 to 2000, right? The last big tech adoption investment cycle that we have seen in the last 50 years. Everybody sees the really important thing, which is, you start when Netscape Navigator was released in 1994, and then you go to the peak in March of 2000, and that was 600% upside, right? 600% in the span of 6 years. But what people often don't pay attention to, because we as humans, we just draw lines and we go, that's really simple, is there were 10% plus pullbacks in that market rally. In 1999 alone, there were 4. In 1998, there was a 35% pullback that if you had sold at the bottom of that 35% pullback, instead of in 2000 being up 600%, you were up 100% from 1994. And so the important thing to remember here is, as long as the credit environment, which the credit environment right now is getting stronger and stronger and stronger and healthier in terms of availability of credit, in terms of banks lending and all this other stuff, as long as that doesn't change, any pullback like that is merely a bump in the road and a buying opportunity in what is going to be an adoption cycle, which I mean, we just talked about. For the grid alone, it's going to be a 5-year plus investment cycle. So just be aware those pullbacks will happen. As long as the credit dynamic, which we are seeing no reason to say it will, is not bad, you should remain bullish on this big AI investment cycle trend.
I feel like this is a perfect illustration of what already happened in November, December, really the end of 2025. Would you say that that kind of qualifies what we just saw, that tech pullback and then a quick rebound? Does that kind of qualify as what you're talking about?
Exactly. I mean, in November, from peak to trough, the NASDAQ actually was down right around 10%. And that's exactly what we're talking about, right? It's stuff like that. When you see that happen, and it's very easy for people to panic and throw up their hands because of it. Do not. Just make sure you check, and this is something that we at Altimetry cover on a monthly basis for our subscribers. We go through, and we also on a weekly basis, even we talk about this. Where are we from the credit market? Because the credit cycle is what really matters for that in terms of whether or not the investment cycles are happening. And we're seeing no reason to think it. But that's exactly right, Bridget. Yeah, it's stuff like that we're paying attention to.
Yeah, if you are loving what Rob has to say right now and you're interested in hearing more from him and his team at Altimetry Research, you can join his program. There's a special offer right now for the new year. You can check out that link in the description to learn more from Rob and his team at Altimetry Research. They cover a variety of different topics. One of the most recent reports is on Tesla and what that company could turn into in 30 years, but they cover a wide variety of stocks. And again, you can join with a special offer just for our viewers here on MarketBeat today. All right, Rob, let's dig into this topic just a little bit more before we get to that third and final theme, which is a really important date for investors to remember. But first, let's talk a little bit more about those AI pullbacks. How often do you think investors should be buying into those AI stocks? I think most people watching this probably are already into AI quite a bit. Some might be selling, some might be buying and adding to the position. But what's a logical strategy for continuing to build your position in AI?
The way we talk about this is I'll actually talk about it in terms of thinking about it from a passive investing perspective. And then before we get to the idea of active investing. So for passive, we always talk about the idea of and that means, right, the money that you need to make sure you have in the market, right? Because what we should all be doing first and foremost is you should never really be buying stocks with cash that you just have sitting in cash. What should always be happening is you should have a bucket of money that you don't need for 5 to 10 years. That money should always be in stocks, should always be in equities, no matter what is happening. Then you've got your money that you need in 2 to 5 years. You might want to buy a new home. Bridget, you might want to buy a home in the mountains, anything like that, that you might need. And for that, you keep that money in bonds. And anything you need less than 2 years, you really probably should honestly have in cash, because you never know what's going to happen for the bond market or the stock market in a 2-year period. But for that money that's in the stock market for 5 to 10 years, that money, like we said, should always be in. If you don't have a single stock that you want to own for a slug of it, it should be in the S&P 500, shouldn't sit in cash. Now, what we talk about is if you get a big bolus of money, you got a lot of money that you want to put to work. Well, we believe in the idea of dollar cost averaging. And the reason why we do is because the fact that you don't know where the volatility of the market's going to be in any 1, 2, 3, 4 month period. And we decide how long what we recommend for dollar cost averaging. We have a system that we put in place. The base of that system first is, again, around what we just talked about, credit. Credit markets and credit environments. Is the availability of credit improving from banks, from private credit, from public market access? Is it getting easier or harder? If it's getting harder, you might want to take longer to spread out that dollar cost average. If it's getting easier and is wide open, you want to do that quickly. The second thing we look at is from credit creation leads to investment. Investment leads to revenue growth and leads to earnings growth. Are we seeing investment and therefore earnings growth accelerate or not accelerate? Right now, we're in a period where we are seeing investment and earnings growth accelerate. And then we look at valuation, we look at market sentiment for very, very short term kind of signals. But for all that, right now, we're at, I think, 6 or 7 months in terms of our dollar cost averaging. That's really fast. So we're saying, hey, look, from that perspective, you want to make sure that you're in this market now because of how bullish all the setups are from a credit environment, from an investment environment. We sometimes are all the way at 24 months and sometimes we're at 3. But so I would say from a passive perspective, it's that. And then, I mean, in terms of when to buy into the AI stocks, we do think that when it comes to active investing, if you are saying, hey, I think that I want to get alpha from a specific stock, oftentimes it's better just to make sure you get into it as opposed to try to time it. But for the market as a whole, right now, we're really bullish. So we're saying a 6-month dollar cost averaging.
All right. A really good roadmap for our viewers to think about and consider for 2026 when it comes to AI investing. Thank you for sharing that, Rob. Let's get into this third theme that you were following and that specific date that all investors should have on their mind for 2026.
Right. And that date, everybody, is May 15th, 2026. And in case you haven't been paying attention on what's going on in Washington, that is when the new Fed chair will be appointed by President Trump. And why is that important? That's important because the fact that, look, you can have opinions on whether or not you think that we should cut interest rates aggressively, but that's kind of irrelevant if you pay attention to what the Trump administration is saying, which is Trump has said, I want interest rates at 1% to 2%. And if he gets a Fed chair in place and he continues to be able to shape the Federal Reserve overall, as he has successfully been doing over the last year and change, there's a really important thing that can happen, which is it comes back to where the consumer is. Right now, if you look at the weighting of the consumer in the S&P 500, right? So you can look over the last 30 years at what percentage of S&P 500 market cap is in any individual sector, from tech to energy to financials. The consumer is currently 15% of the S&P 500. That is by far the lowest percentage the consumer has ever been. And I mean, in Bridget, we know why, right? It's obvious, right? I mean, the consumer's under pressure, right? You've got high levels of debt, you've got rising unemployment, you've got concerns for disruption, you've got, accelerating delinquency rates from everything from student loans to cars to credit cards. There's a lot of reasons for that. But if you aggressively lower interest rates, you effectively give a safety valve for the consumer. It's not going to fix everything for the consumer, but it is a safety valve for the consumer to have a little more room to breathe. And we just think that with all these consumer stocks being beaten up as much as they are, that there could just be, quite frankly, a really aggressive bounce in some of those stocks, not dissimilar to what happened for healthcare companies in the final quarter of this year. So we just think that's a really important thing that everybody's asleep on the consumer and they should pay attention to.
Yeah, I think that this is a good time to talk about taking your emotions and your opinions and your thoughts out of investing is so important for retail investors, especially. It doesn't really matter what you think about your opinion might be on that interest rate change, on the Fed, and what they might do. It really matters how to manage what might come. So if it is looking like, yes, this is going to happen, and yes, the interest rates are going to go down, it's so important to know as an investor, this is what you need to watch. I think that that's such good advice for investors to remember. Let's talk about some of the specific consumer stocks that could be impacted after that May 15th magic date when things could really change.
And of course, once this is all settled on it, some of these stocks are probably going to move before May 15th as people really realize, okay, this is going to happen. And one of them is Douglas Elliman. And what this company is a real estate broker. It's been really, really hard being a real estate broker the last few years because with high interest rates, it's hard for most people to finance, right? I mean, we had a data point, which is wild. And it's, Bridget, surprising me that I've never seen anybody taught this way, but we just did the very simple math for the carrying cost of a home, which is a mortgage, right? The mortgage is actually, everybody, right? You need to understand when it comes to buying or selling a home, it's actually, I know this sounds absurd to say, the list price of a home is not what's relevant because the fact that you can always find ways, you don't have to put 20% down anymore. Like, yes, you should, but you can put 5%, 10%, even less down in different things. What matters is the carrying cost of the home, the mortgage payment. That's the affordability question for you. And because what happened in 2022, when prices of homes didn't come down, but mortgage interest rates did, you saw the price of a home, which effectively for 20 years had been close to flat in terms of the actual cost of a home, in terms of mortgage, doubled overnight, basically. And that's the issue. And so you think all of a sudden, if Douglas Elliman, who is in the business of buying and selling homes, gets a bonus of the fact that interest rates drop, a lot more people are going to be able to sell their homes because they're not stuck in 3% mortgages they can't get elsewhere. And a lot more people can afford to buy homes. And so you look at this is a company that in good times, our uniform return on assets for this business can be north of 25%. Right now, it's basically zero, and the market's expecting it to be a 5% return on assets. If this company sees 10, 15, 20% return on assets, this company is going to be making so much more money, and people are totally sleeping on it because they're sleeping on the consumer overall.
Yeah, I think the housing market is going to continue to be one to watch in 2026. So we covered 3 themes in this video, but there are so many things that can happen in a full year in the market. Are there any other areas that could maybe be surprises that you're kind of bracing for in this new year?
People really are sleeping on the idea that Russia and China are both basically playing from a very weak hand geopolitically when you look at them from their tax-based perspective, from the economic perspective. And 2026 could be the year that we really start to see for both of them, the overplayed hands that they've had start to come home to roost. And what does that mean for America? What does that mean for investing overall? It's a place to pay attention to because a lot of people think they're coming from a much stronger hand than they really are. And it really jumps out when you get into the real numbers that we look at on a regular basis.
Okay, interesting. The Russia and China market discussion is a very very interesting one for 2026. I know there are other countries that did incredible in 2025 and are expected to do really well in the new year as well. We just posted a new video covering exactly that, these big emerging markets that are actually growing faster than the US, and 3 stocks to watch in those markets. Check out the video with Thomas here.